Welcome to the Retirement Evolved podcast with certified financial fiduciary Adam Bruno.
Yeah.
Yes, sir. And we're here again, everybody. Thank you so much for listening. Adam, how are you, my friend?
I am wonderful, Bill. Every time I hear that music, and whoever does that introduction, that's lovely. I love the voice. Yeah. It's great.
That's our guy, Chris Carter. I'll let him know you're impressed. I'll let him know. We get together all the time to talk about retirement, how to plan for retirement, and to make sure that what your plan is going to get you through your retirement years. Because, boy, a lot of us are having a lot more of those years in front of us than there used to be, right? I mean,
right. Well, we had 15 pretty good years, and now and now things are looking a little bleak again.
Yeah, they are. But we get together every week to talk about it. Before we get rolling on the show, I'd like you to please go ahead and hit follow, subscribe, like, whatever the button is on your podcast player. That'll help us a lot if you don't mind. We'd appreciate it very much. And, you are listening because you're here for some retirement information. And Adam Bruno is the guy. He's got your information. He is a certified financial fiduciary with Evolution Retirement Services and Evolution Wealth Management. Not just with them. You own them. I hate to slight you.
Them. Well, let's be real about this. I am nothing without the team behind us. I mean, it started out as a vision, and we were able to find a lot of success. We have 2 CPAs, 2 estate planning attorneys, a couple CFPs. So we have a really good team, Bill. In all fairness, it was definitely just my idea, but a lot of other very important people and very hardworking people, just like me, took it and ran with it, and everybody shares the same vision now.
And, of course, you can find out more about these good folks at give them your website.
Sure. So we have evolutionretirementservices.com. And then the other website, the one that's I like to say is the easy access website, is taxfreefortmyers.com. That's FORTMYERS. And you can see all of our, articles. I'm doing 2 articles for Kiplinger this year. My book's there that I wrote. Everything's there. It's completely free. All you have to do is put your email address in, and you'll be in the loop with us. You'll get all the newest information as it comes along.
Absolutely. And make sure you spell out Fort in taxfreefortmyers.com.
That's right. That does seem to be, I don't know when we got so lazy in the society that we can't spell anything out anymore, right, Bill?
Well, when we started texting and using initials like TFN and, stuff like that rather than spelling out
I don't know what that means, Bill. I'm still catching. I have to look it up when my kids text me. There's a new one every week, it seems like.
Oh, man. Well, one thing, unfortunately, we've all caught up with is the fact that inflation is here. And buddy, is it, huh? Surged to a new 4-decade high in June. The government's consumer price index soared 9.1% over the past year, the biggest yearly increase since 1981, with nearly half of the increase due to higher energy costs. And we went out and asked a few folks who lived through the 70s towards the early 80s about what it was like with the inflation then, and is it just as bad now?
Inflation back in the 70s really never impacted me because I lived in an apartment with a roommate. I lived a much simpler life. I don't think I realized the impact of it as in comparison to today where building materials, food, some of the more important things in life have really taken a hit and caused our budgets to swell.
So far, it's just an inconvenience.
My father-in-law brought it up just the other day, and he hasn't seen inflation this bad since the 70s.
I got out of college in 1975, and things didn't seem too bad for me at the time. But looking back, inflation lasted a long time. I just hope we're not in for that again.
Well, I think we all hope we're not in for that again.
Amen, Bill. It's so interesting because what a great perspective from those families that made those comments. It's just, for us, we have been so spoiled, it seems like. I mean, I know for a fact 1981 was the last year that we had double-digit inflation. That was the year I was born. And, you hear these families tell their stories. And looking back, I think the most important thing that someone said there was that it was a much simpler lifestyle back then, and that's really key. It was a lot more simple. It seems like lifestyles continue to get more and more advanced with the technology and the toys and buying and keeping up with the neighbors. And it's almost like we've gone through this huge wave and what a difference from the 70s until now, right?
Oh, yeah. I mean, that's the double-edged sword of technology, right? It does some wonderful things, but, for those of us that grew up in the 70s where you stayed out till the streetlights came on, and then you came in and watched maybe an hour of television and went to bed, and that was it. You hung out, you listened to your radio,
What was on TV in the 70s, Bill? What was
man.
back there?
Well, let's see. Well, when I was done playing with my hoop and my stick, and I would come inside, I don't know.
Hey, you had a TV that was like 12 inches, right? The radio had just gone out of style.
Yeah, man. We were watching, in the 70s, the big stuff was like Happy Days, Welcome Back, Kotter,
Happy Days,
Barney Miller, a lot of that stuff.
Yeah.
The classic
just good old-fashioned
stuff.
TV, golden age of TV, right?
Yes, where you look at it now and go, really? That's what I watched.
Well, and that's my point, right? I mean, so much of what we talk about when it comes to retirement and investments, and when you put it in perspective with what people have seen over the years, you can't help but be anything but scared. I mean, it is a completely different world now. Listen, I'm not a doomsday prophet or anything. I'm not saying that, oh gosh, the world's going to hell in a handbasket. I'm not saying that. All I'm saying is that it's different. It's very different, and it's very hard to navigate through that type of a situation today. It's just information is readily available, and it's almost like we never stopped to think, we kept saying we could get all this information online. We could Google everything. We never stopped to think whether we should, because information overload is a real thing. It's fine to get the information, but if you don't know how to interpret it, if you don't know what it means, that's how people end up losing money. And I see it on a weekly basis.
What I loved about the 70s was, we only had 3 TV stations and we all hated the Russians. I mean, we knew where we stood. That's all we had to. Sometimes I think not knowing stuff, you're right, is better because it doesn't weigh you down, because all this access that we have and all this stuff that we read, it's going to be depressing for a lot of people. And so, I think that not knowing things sometimes is a better avenue to go. But then again, it's hard to stay in the dark these days with everything that's out there. So let me ask you this, Adam. With the inflation that we're facing, with the rising cost of everything,
right?
As somebody who is getting ready for retirement or is investing now, trying to build their retirement plan, what are some of the avenues that they should consider and maybe not consider? I mean, I hear things all the time from different IRAs to mutual funds to, just put it in your mattress. I mean, all these different avenues. What are you telling people?
Just like we've discussed in the past, Bill, there's 3 things that I tend to focus on. That's going to be, taxes. And we're going to talk about this idea of Roth versus traditional IRA, Roth conversion, and then Medicare surcharge. Those are the 3 things that keep repeating themselves with all of the successful families that we see. And if you haven't, we've tried to touch on every one of them here and there. Of course, we only have so much time. It is in my book, of course. But one of the big red flags for me, personally, when I sit with a family, because I do sit with everyone. When they come in, we sit with everyone. Gosh, I just have to say that if you're in your 60s or your 70s and you're still invested in mutual funds, at this point in most of those families' lives, it becomes the possibility is there that it's just a bad investment at this point. And I'll tell you why. Mutual funds are created in a way that families just kind of hang on for the ride. They only trade at the end of the day, so you don't know what's happening. And if something goes down, you can't trade it till the end of the day. But beyond all of that, mutual funds, the way that they're invested, there's an internal cost of doing business inside of a mutual fund. And those fees can range anywhere from, 50 basis points or 0.5% all the way up to 1.5%. And that's just the cost of owning the mutual fund. There's nothing we can do about that. Now, other advisors, again, air quotes, other advisors will tell you that, well, it comes right from the performance. You don't notice it. Well, I could understand that when you're working and accumulating your money for so long, because you have so long to overcome those internal costs. So mutual funds could be a good tool for that as we're working and we're accumulating our wealth. But the reality is, in retirement, we don't necessarily need to pay for that type of investing anymore. And some people are so dependent on mutual funds that they even have bond funds inside of mutual funds. So not only are we losing money on the bonds, because we talked about that, right? Just the environment we're in right now. Yep. Bonds are not performing and they're losing money. Now we're losing the performance cost. We're losing our fees, we're losing everything. And then we're losing the time away from other investments that could have made us money. So what I would say about mutual funds is they are gloriously inefficient in retirement. There is much better bang for your buck in the exchange traded fund world. And an exchange traded fund is structured, it's called an ETF, exchange traded fund. It's structured very similar to a mutual fund. The only difference is exchange traded funds trade all day, anytime the market's open, every 5 seconds. And they are going to have investments inside of them. And there might be multiple investments, but the internal cost of that investment is a fraction of a percent compared to, 0.75% or 1.5%. It's a fraction of a percent. And you do get similar performance. You can have similar performance or even better performance. It just depends, right? It's like anything else. It depends on how you're invested. But an exchange traded fund in the retirement world is, to me, it's one of the first steps to becoming more efficient. You do not need to spend all of this money on mutual funds. All of it, my old mentor used to say that mutual funds had iceberg fees. And I don't know if you know this, Bill, but the biggest portion of the iceberg is underwater. You don't see it. Right?
Yes.
So that's that whole idea that there's all these, for example, mutual funds have 12B1 fees, which is a fancy way of saying that everybody invested with the mutual fund is paying advertisement costs. So when you see, a big, huge commercial on Fox Business for a mutual fund, or you see a nice big full color page ad in the New York Press for a mutual fund, you're paying for that if you own it. I mean, that's who pays for it, the people that own it. Wow. So we're really inefficient in retirement, or we can be, with mutual funds. And there's, I'm sure, just like anything else, you have some that have performed. I have not seen a lot of them performing right now in the environment that we're in. And that's when it really starts to sting, Bill, is you have these mutual funds and now they're going down, right? Because the market is down and we started to see this downturn. Not only are the funds themselves down, but then you have to add in your cost, what you might be paying your advisor, the fee. Then the internal costs, those internal fees, you add it all up and we're significantly down. You're far more down than somebody who had an exchange traded fund, right? Or somebody who used an indexing strategy. So this idea of being more efficient in retirement is really what we strive for at Evolution. With both companies, it's about being more efficient. It's about consistent compounding returns rather than 20 or 30% returns. Again, those are great when we're working, but now in retirement, it just makes us gloriously inefficient, especially if we have a 30% return in an IRA, but we have no plan on how to keep that return because we have no advanced tax plan, because eventually you have to pay taxes on that IRA. So it's a nightmare right now for families who have been so used and so coached to do it one way, especially with mutual funds. It's just, and if you go to any of the big boys, the Edward Jones, the Morgan Stanleys, the Merrill Lynch, a lot of them are mutual fund heavy, especially, like an Edward Jones. They created American funds, which are mutual funds, and they're Edward Jones products. So now you're paying an Edward Jones advisor. Now you're paying Edward Jones, additional fees on what you're investing. And it's all legal. They can all get away with it. It's legal.
Well, I was going to ask you that. Are the mutual funds usually done through the big box houses that we hear about, the ones you mentioned? Is that normally how that happens, or?
Well, you have a lot of advisors out there who are paid commissions based on selling mutual funds. There's a couple different types. There's what they call A-share mutual funds, and there's every letter in the alphabet after that, all the way up to Z. But A-share mutual funds, and this is where families can tell if they're in a little bit of trouble. A-share mutual funds pay a big upfront commission to the person who sold it to you. And it doesn't have to necessarily be with a big box firm. It could be, anybody could sell you a mutual fund if they're licensed correctly.
Okay.
But they're paid a big commission up front, so then, and then on the opposite side, there's C-share mutual funds where you're paid a little bit of a commission up front. And then there's a constant fee on the back end that you're paying on top of that. So what ends up happening is everybody's making money except the investor because we're paying all these fees. So this idea of, who can sell them? Well, anybody can really sell them. It's whether they work best for us or not, right? And you can always tell. You go and sit down with somebody and they'll say, I've got this great fund. It's been working really well. Not, hey, let me check your risk tolerance. Let me ask you a few questions. Let me make sure what your goals are. And then we can talk about what kind of investments might end up meeting those goals. Because they have to feed their family too, right? And mutual funds are going to pay them the commissions, right? It's just the way it is. It's a dog eat dog world out there.
Right. And that gets back to one of the things that we've talked about before, where a lot of times you sit down with people that are looking for a new advisor or looking for help, and you ask them, okay, well, if this is what you're doing now, what fees are you paying? And most of them don't know.
I think we talked about this before. And I don't say it to be, spiteful at all, but it always surprises me when I can sit in front of families and I literally think in my head, these poor families, if they had a gun to their head right now and I told them that they had to tell me exactly what they're paying in fees, they wouldn't be able to do it. And now think about that. I think I've said this before, Bill, but we know what we pay our co-pays for our doctor. We know what we pay for our prescriptions. We know what we pay our CPA. We know what we pay the person who cuts our lawn.
Right.
But we hand somebody our life savings and we don't know exactly what we're paying. That's scary. And it's, to me personally, on a moral level, as a fiduciary as well, it's unacceptable that families go through their investment lives not knowing exactly what they're paying. And I'm not saying that like it's their fault. I'm saying that because they should have been educated exactly on what they're paying. And they do. An advisor to cover his track will say, well, I gave you a prospectus. Have you ever seen one of those prospectuses?
Sadly, yes. I can't read it.
About 100 pages, right? Yeah. You know, it's like, one of my favorite movies growing up when I was a kid was Beetlejuice. And right. One of the common lines in there was, this thing reads like stereo instructions. You know, right. Like that's the whole thing with these prospectuses. These people are not trained. They don't know. They're not licensed. Families are not trained or licensed. They don't know what some of these terms are, what this means. So why couldn't somebody take 5 extra minutes and point out the fee section and say, okay, just so you know, these are your fees. This is what you're paying. 5 extra minutes.
I agree. And then, of course, you also have the flip side, though, of like you said, those who don't even ask. And that's on you as somebody getting ready for retirement. Never be afraid to ask that question because, just like Adam said, we know what we're paying for everything else, right? Why wouldn't you ask what you're paying to have somebody handle your money?
Right. And Bill, you are kind of hitting the nail on the head there when you say, it's on them. And that's true. What I would say in addition to that is, don't feel bad or, kind of ashamed or angry if you haven't asked, because if your advisor, again, air quotes, did their job, you trust them. So it's kind of like this idea of, well, should I really ask them about that? I trust him or I trust her. And the answer to that question is yes, you should still ask them because they'll respect you even more for asking if they're doing their job right.
Well,
and I'll tell you what, I'm going to get a bunch of emails or a bunch of phone calls after this. And they're going to say, wow, I asked, this is what they told. They might still confuse you with their answer. But the reality is what you really need to know is, let's say that your advisor's name is Jen. Jen, am I paying you a fee to manage my money? And Jen might say, yes, you're paying 1%. Okay, Jen, what about my investments themselves? Do they have any fees inside of them that come, and you can use the term that might come from my performance? Because sometimes if you don't use those terms, they won't tell you about it. But you are more than welcome to ask them those questions, and they are legally obligated to answer you. Even if they say, well, it's in your prospectus. They can't say that when you ask them directly. Well, could you dig out my prospectus and look with me so I know what I'm paying? There's nothing wrong with that, but for some reason there's this stigma attached to it right now where since we trust someone and since we've done business with them for so long, we don't really need to ask. That's absolutely not true. How many of you out there every year, and if you're a successful family, you probably do this. Every year you check your car insurance rates. Every year you check it's common sense. You should not be afraid you're paying them. Just remember that. You are paying your advisor. So when you ask questions, you are well within your rights to ask as many questions as you want. They're making money off of you. They work for you. Absolutely.
And as my dad used to say, just because you trust somebody, a lot of babies are born on trust me. You want to. Oh wow! You want to make sure that you even though you trust him, you still need to know what's going on. And you know what, Adam has written a great book that covers a lot of this stuff and everything else you should know about retirement. It's called "They Lied: The Real Cost of Your Retirement." And in this book, you're going to find out exactly one of the topics is questions you should ask your advisor. Mistakes to avoid with your IRA and 401ks, the difference between investment consulting and wealth management, because there is a difference if you did not know that. Adam goes over all of this in a great book. It's called They Lied: The Real Cost of Your Retirement, and you can download a free copy at taxfreefortmyers.com. That's F-O-R-T. Make sure you spell out Fort in taxfreefortmyers.com.
And Bill, I just want to speak to that for a minute. We've talked about that so many times. I've heard you say that phrase, and we've never actually really talked about it. The difference between investment consulting and real wealth management. That's why I don't like to call myself a financial advisor. I haven't corrected you at all, Bill, when you've done it, but I like to call myself a private wealth manager because of the fact, and it's as simple as this, investment consultants, They tell you how to invest your money, where to invest your money. You give them money. And maybe this is while you're working as well. You give them money. You contribute every week, every month, whatever it is, and you grow your money for retirement, or you continue to grow your money after retirement. And we've talked again about why that's such a big mistake. It's not about performance anymore. So investment consultants are there to help you decide how to invest, to watch your investments, to grow your money, to make you money. So that's fine. That's all well and good during our working years because we want to accumulate as much money as we can. Investment consultants are not wealth managers, though. Investment consulting, or IC, is a piece of what wealth managers do, but it's not all of it. The big piece that's left out when we talk about the difference between wealth managers and investment consultants is what we like to call the advanced planning. Now, advanced planning has to do with, possible Roth conversions, advanced tax planning, estate planning for wealth transfer, Medicare planning, everything that you're going to be affected by in retirement, and having the correct professionals to help with that. An investment consultant that's operating on his own or knows a guy that can help with taxes or knows somebody for this, that doesn't mean they have the team in place that they've worked with for years. And that's what's important, having that team in place that have spent years working together. So advanced planning is a very big piece of what a private wealth manager does. And that's the difference between wealth management and just investment consulting. But it's also something that I like to call relationship management. Relationship management is so important because it's not just somebody might come in and say, okay, I have a problem with my money. And an investment consultant will say, okay, well, we'll move this here, or we'll do this, or we'll buy some of this. That's not relationship management. Relationship management is somebody coming in and saying, okay, and I'm getting ready to sell my house. I'm getting ready to make the move full time down to Florida. I'm getting ready to do something, and us having a relationship with a professional that can help them on that path, whether it's getting a mortgage, whether it's building a pool, whether it's whatever it is, contracting. We have professionals in a professional network of vetted individuals who we've used before, and they can help with any relationship that needs to be established, whether it's financial, whatever it might be. It could just be redoing the kitchen. I could go on and on. Travel assistance, travel planning. We have all of these teams of professionals who have been vetted, who we've used before, and all of those items together are what make a wealth manager and what make wealth management. It's not just the investment consulting. 100% of financial advisors out there are investment consultants. That's all they do. But not everybody is a wealth manager or follows that wealth management formula. So that's the difference. I don't know if we've ever explained that before, but sometimes that might help people understand.
No, I don't think we've gone that in depth, Mr. Private Wealth Advisor. I apologize.
Wealth manager.
I'm sorry.
Wealth manager.
Private wealth manager. I still can't get it right.
We'll get there, Bill. We'll get there.
But that is important to know. And especially if it is, that really does kind of help decide which way you want to go and who it is that you think can help you the best. So, again, a lot of these questions are answered in the book, They Lied, The Real Cost of Your Retirement. That's Adam Bruno's book. He has written it, and he's giving it away at taxfreefortmyers.com. Just go there today. You do have to put in your email address, and that's how you get the book. Trust me, I did it, and the good news is that you're not going to get a bunch of email from him.
Right, you're not going to get spam bombs from me. Yeah, that's Bill. The other thing that's interesting is we had a question last week, and the question was, I have all this cash right now. What am I supposed to do with it? And believe it or not, I know there's a lot of people out there that say, well, you could do this, you could do that. Believe it or not, that's a really hard question to answer right now because, again, if we have all this talk about recession, right? This is why I say we're already there, Bill. When you get questions like that, people have $300,000-$400,000 in cash and they don't know what to do. So again, I like to think that I'm a little bit more than just somebody who tells you how to invest your money. I like to think that there's always a plan in place. But I will tell you this, Bill, and I want to tell everybody this. You could right now go on the Treasury website and you can buy what they call an I bond or an inflation bond. And these bonds, unlike normal bonds, are tied directly to inflation. So right now, I think it's like 9.6% that it's paying because it's tied to inflation. A couple months ago, it was in the 7s. So it just keeps going up because inflation is on the rise. Here's the problem, though, Bill. You can only do $10,000 per person per year. So you could certainly buy one for you, one for your kids, whoever it might be, right? You can put them in other people's names, but it's only $10,000. What I will say, though, is that even 9.6% on $10,000 is better than, sitting in a bank and not getting anything on it. So that's one area where you can really address it right now, be a little bit more efficient. I know it might not seem like much on 10,000, but the reality is, it's a pretty good thing. And you don't buy those from me, Bill. You actually go right to the U.S. Treasury website and you buy them through there. That's something that you can do. CD rates right now, kind of in the toilet a little bit. We've been using what we call multi-year guaranteed annuities for our families. An annuity is a very, very dirty word, Bill, so I want to make sure I clarify this. You can look this up. If you're listening now, you can look up multi-year guaranteed annuity, and you will not find one lick of bad press on it, okay? The reason that it's not brought up more often is it does not pay a high commission. So all of these advisors out there, it might pay a 1 or a 2% commission. So people can't make a lot of money on it, so they don't talk about it a lot. I talk about it all the time because I think it's great right now. Right now, you can get a 5-year fixed rate of 4.5%, 4.5%. I mean, where are you getting 4.5% somewhere else? It's basically a CD issued by the insurance company. And the nice thing about that is, unlike a CD at the bank, you're not going to get a 1099 every year from the insurance company. You don't have to worry about the taxes till your time period is over. And then you can, so those are things you can do right now with cash that you don't necessarily need. I know it's not a lot on the growth side of things, but gosh, it's better than nothing right now. And people are so nervous, and I don't blame them for it.
Yeah.
But it will cost you if you don't really strategically plan this out. There's many other things you can do, but those are two of the easiest things that I know of right now. And I know that nobody's talking about MYGAs or multi-year guaranteed annuities. It's just, there's not enough money in it, so nobody's talking about it.
Well, these are the reasons that you want to stay in touch with Adam and keep following the podcast. So please, again, subscribe, like, follow, whatever the button says, depending on your podcast player. Go ahead and click it now. We would really much appreciate that. If there's something you heard today during the podcast that you've got questions about, feel free to give these guys a call. Let me give you a phone number for you. It's 866-838-3765. 866-838-3765. That's the number you can call to get in touch with the good folks at Evolution Retirement Services, or check them out online at evolutionretirementservices.com.
Right, Adam? And Bill, so important, just remember, we say this a lot, and it's absolutely true. When you call us, you talk to me, and it's a conversation. We do not work with everybody that we come into contact with. Our goal is to help everybody we come in contact with, because there's no bad that comes out of that. I used to be the king of the salesman, 7 or 8 years ago, and I used to make a lot of money. I made my most money when I switched my model from selling to helping. That's when we were able to find our most success, because when we put everyone who calls us first and we do as much as we can to help them, good news travels fast, right? And that's the idea. So we're going to treat you like we would treat our family. It's usually a 30 to a 45-minute conversation. And I just want to understand as a fiduciary where you are, where you'd like to go, what your concerns are, what you're trying to accomplish, and we're more than happy to help you with all of those issues, whether we end up working together or not. I just want to make sure I'm real clear on that, Bill, as always. Absolutely.
Absolutely. That's a good way to end things today. Again, if you want to get in touch with Adam, you can give him a call at 866-838-3765. Buddy, it's always a pleasure to be with you. I learn stuff every time we get together, and let's do it again soon.
How about next week? That good for you?
Yeah, we'll fit it in. We'll see what we can do. And by then, I will know exactly what to call you, that I'm not calling you off the air.
You're not allowed to say those things.
No.
Remember. Okay.
Investment advisory services are offered through Evolution Wealth Management Incorporated, an investment advisor registered with the state of Florida. Registration does not imply any level of skill or training. Evolution Wealth Management's unique CRD number is 307644. You can obtain a copy of Evolution Wealth Management's firm brochure, Form ADV Part 2A, free of charge by visiting advisorinfo.sec.gov. Evolution Wealth Management offers investment advisory services only, where it is appropriately registered or exempt from registration, and only after clients have entered into an investment advisory agreement to confirming the terms of engagement and have been provided a copy of the firm's ADV Part 2A. Insurance services are provided by Evolution Retirement Services. Any guarantees mentioned are backed by the financial strength and claims-paying ability of the issuing insurance company and may be subject to restrictions, limitations, or early withdrawal fees, which vary by the issuer. They do not refer in any way to securities or investment advisory products. You should consider the charges, risks, expense, and investment objectives carefully before entering a contract. This material has been prepared for informational purposes only and should not be construed as a solicitation to effect or attempt to effect either transactions in securities or the rendering of personalized investment advice. This material is not intended to provide and should not be relied on for tax, legal, accounting, or other financial advice. Evolution Wealth Management and Evolution Retirement Services do not provide tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Evolution Wealth Management and Evolution Retirement Services are affiliated entities.